Welcome back, everybody. I hope that you had a good day today. We are gonna continue from where we left yesterday. So I'm just gonna have a quick recall of what we were actually discussing yesterday. So our discussion in the yesterday's session was mainly based upon that we were actually talking about the audit reports, and when we were talking about the audit reports, so we talked about that how the content of the audit report has changed. We also discussed this concept that the new content and the key audit matter section of the audit report, and we also talked about that how the key audit matter section is being presented in the audit report. And the further thing that we talked about was the other information section in the report. In addition to the other information section, we also talked about this other information and then modifications to the opinion. And when we talked about the modifications to the opinion, so we talked about how the modification to the opinion actually affects the key audit matter section. Furthermore, we talked about these all various different types of modification, that under what circumstances what sort of modification arises. And then we move forward, and what we discussed further was that the emphasis of matter and the other matter section. This is this is where we actually discussed. Unfortunately, we had disturbances due to this technology yesterday, but hopefully that the session will go over in a proper and a smooth manner today. So let's start discussing. Let's just have a quick discussion. If I could recall, I asked you people to go through question number 5. I asked you people to go through question number 5 of December 2014, because December 2014 question number 5 was something that pertained to the audit report. So I'd ask you to actually go through that question. Let's December 2014. So it was December 2014, question number 2. These questions are also available in the handouts. Okay, so this December 2014, this is the question about the Bradley company. So let's just have a quick recall of the things that we discussed about the Bradley company. So if I talk about the Bradley company, so this is actually December 2014. Question number 5, part B. It says the schedule of proposed adjustments to the uncorrected misstatements included in Bradley Company's statement in audit working papers is shown below. So it's shown below, and it says including the notes to explain each matter included in the schedule. The audit partner is holding a meeting with the management tomorrow at which the uncorrected misstatements will be discussed. So the uncorrected misstatements will be discussed. Now it says propose adjustments to a statement, uncorrected misstatement. There could be 3 adjustments: share-based payment, at the same time restructuring provision, and the additional allowance for slow moving. So now number 1. Questions requirement is explain the matters which should be discussed with management in relation to each of the uncorrected misstatements. So the matters which you need to discuss with management. The second thing is, assuming that management does not adjust the misstatement, justify. Whenever the questions requirement says justify, justification means you need to actually explain that why do you suggest a qualified opinion or why do you suggest an adverse opinion. Justify an appropriate audit opinion and explain the impact on the auditor's report. Now, number 1, it says share-based payment scheme was established in January 2014. Management has not recognized any amount in the financial statement in relation to the scheme. arguing that due to decline in Bradley Company's share price, the share options granted are unlikely to be exercised. The audit conclusion is that an expense and any related equity figure should be included in the financial statement. Now see, if you could just recall what IFRS 2 states. So the IFRS 2 actually says that there could be multiple types of transaction, and amongst the various transaction, one of them is equity settled share-based payment transaction. One of them is equity settled share-based payment transaction. So amongst the various transaction, one of them is equity settled share-based payment transaction. Now if I talk about equity settled share-based payment transaction, so how do we record this transaction? We record this transaction as expense debit and correspondingly equity credit. Now, majority of the cases, what happens is, what sort of equity instruments do we provide? So the equity instrument that we provide is majorly the share options. So majorly they are the share options that we provide to the employees or to the suppliers, etc., etc. So generally it's expense debit, equity credit. Now, expense debit, equity credit, that is something that has to be recorded. You do have an idea that whenever you grant share options, so when you grant share options to anybody, you are giving them an option that if they want, they can buy the share. If they don't want, they cannot buy, they don't buy the share. So option holder has got two choices. Either he could exercise the option or he could lapse the option. I'm repeating it again. The option holder has got two choices. Either he could exercise the option or he could lapse it. So now IFRS 2 says that the entity has to recognize expense irrespective of whether option will be exercised or not. So you need to recognize the expense irrespective of whether the option will be exercised or not. So here the auditor has proposed an adjustment of what auditor says, that you should debit the profit and loss account and you should credit the statement of financial position, meaning that the auditor is asking them that recognize the expense by 300,000 and correspondingly you need to recognize an equity credited by 300,000. That is what you have to do. So that's what the auditor is trying to explain to the management. Now the management is of the view that due to decline in the Bradley Company's share price, the share options are unlikely to be exercised. The audit conclusion is that an expense and related equity figure should be included. So I'm going to talk about it, that how exactly should you talk to the management with respect to this whole. So the way you should talk to the management with respect to the whole of it is going to be like this. So we would explain to the management that look, this we would explain to the management like, look, IFRS 2 share-based payment transaction, this is actually an equity settled share-based payment transaction in accordance with IFRS 2. And when it comes to equity settled share-based payment transaction, you need to recognize the expense irrespective of. You need to recognize the expense irrespective of whether options will be exercised or not. So what does IFRS 2 says? IFRS 2 says that it's an equity settled share-based payment transaction. You need to recognize the expense irrespective of whether the option will be exercised or not. So basically what the entity needs to do over here is they need to recognize the expense debited by 300,000 and correspondingly equity credited by 300,000. So that is answer to part A, that you need to discuss the matters that need to be discussed with management, number one. Number two is you have to actually advise that in case if the management, what is your requirement? Assuming that management does not adjust the misstatement, justify an appropriate audit opinion and explain the impact on auditor's report. So now, if I say that the management does not, make an adjustment, so what am I going to do as an auditor? As an auditor, what am I going to do? I'm going to say that 300,000 divided by, you have got a total revenue of 2.5 million. You don't have a profit, but since the expense is a P&L item, since we now don't have the availability of the profit, we can compare it with the revenue. So 300,000 divided by 2.5 gives you what? Can anybody please confirm to me that how much is it? 300,000 divided by 2.5 million, 12%. Okay, 12%. Similarly, this 300,000 divided by the total assets of 35 million, how much is it? Okay, so it's 0.85%. So what do you need to talk about? You need to say that this 300,000 is material from the perspective of the profit and loss account, that it is 12% of the revenue, but it is not material from the perspective of the total assets. So it's not material from the perspective of total assets. That's what you need to comment. Now what next? Let's move forward. So since this is a material misstatement, so as an auditor, what are you going to do? You're going to say if this is a material misstatement, then what we need to consider is we need to actually, it's a material misstatement and the matter is non-pervasive. Now, why is it a non-pervasive matter? If I see it to be a single matter, it's not a substantial portion. And then the multiple items are not affected. It's just a single item and it's not a substantial portion. So basically, what are we going to do? We are going to say that if it's a non-pervasive matter, then you need to recognize, you need to give a qualified opinion, qualified except for opinion. So as an auditor, what do you need to do? You need to say that the entity should give a qualified opinion with the explanations in basis for qualified opinion para. Okay, so we are done with it. That's one part. Now, number two part here is basically the questions requirement is about. It says restructuring provision. For this, it says profit and loss account should be credited and a statement of financial position should be debited. That means, what is he trying to do? He's saying you do the SOFP debit and you do the profit and loss account credit by 50,000. That means what they are trying to do is that they are actually trying to reverse the provision. They are actually trying to reverse the provision. Now, how exactly are we going to reverse the provision? So let's just try to understand about it. It says the provision has been recognized in respect of restructuring involving the closure of one of the steel processing plant. Management approved the closure at a board meeting in August 2014, but announced the closure to employees in September 2014. The audit conclusion is that the provision should not be recognized. Now, if I talk about it, we are dealing with a year end of 31st August 2014. If you could recall a bit of IAS 37, the provisions, contingent assets and contingent liabilities. IAS 37 talks about restructuring. So when IAS 37 talks about restructuring, so restructuring in accordance with IAS 37 actually covers up what? IAS 37 says that restructuring provision shall be recognized when the entity has a constructive obligation to restructure. And when do we have a constructive obligation to restructure? So the constructive obligation to restructure actually exists when you have got a detailed formal plan. When you have got a detailed formal plan identifying what, we'll talk about it, and then a valid expectation is created amongst the those affected by either announcing its main feature to them or by starting to implement the plan, or by starting to implement plan. So, and when we talk about detailed formal plan, identifying what number of employees to be affected, at the same time the locations that are to be affected, the expected cost to be incurred. So number of employees to be covered by the plan, the locations, the cost to be incurred, and date when it will be implemented. So these are the few things that need to be identified, and they are the important things. Now let's just talk about it. So if I talk further, so I would say that if you look at this scenario, in this scenario you will figure out one thing, that the entity has actually announced the main feature to employees in September 2014. So when the entity has announced the main feature of it to the employees in September 2014, that means it is after the year end. And when it is after the year end, it's not an adjusting event. It's not an adjusting event. It's a non-adjusting event, because at the year end the employees did not know that this is something that is happening. So what do you need to do? You need to explain to the management, and you need to tell them that, look, the restructuring provision can only be recognized when you have a constructive obligation to restructure. And for you to have a constructive obligation to restructure, you need to have X, Y, Z things. So since you have not announced the main feature of this plan to the people, or you have not actually created a valid expectation amongst them, therefore you cannot recognize the provision. So what you need to do is that you need to reverse the provision. So that's what you need to explain to the management in this scenario. Okay, now let's move and let's just discuss about how the reporting implications would be. So if I talk about the reporting implications, so you would figure out that what is 50,000 divided by the revenue, and 50,000 divided by the assets. How much is it? Okay, this 50,000 divided by 2.5 million. How much is it? .2% or 2%? Okay, it's 2% of PBT. So this is immaterial. Similarly, you compare this 50,000 divided by 35 million, you will then again this thing to be immaterial. So that means apparently what has happened is the thing is that it is immaterial. So it's an immaterial misstatement. It's an immaterial misstatement. So immaterial misstatement has got no impact on audit report. They've got no impact on audit report whatsoever. Okay, let's move forward. If I talk further, so the number 3 thing is additional allowance required for slow moving inventory. If I say additional allowance required for slow moving inventory, so let's just talk about that. What exactly is it? It says the estimate relates to slow moving inventory in respect of particular type of a steel alloy for which demand has fallen. Management has already recognized the provision of 35,000 which is considered insufficient by the auditor. So how exactly are we going to deal with this scenario? The simple thing is we are going to say that the IS2 states that inventory should be written down below the should be written down at the lower of, should be recorded at the lower of cost or NRV. So now in this case, if and the NRV is basically the estimated selling price minus estimated selling cost minus estimated cost to be incurred to bring into saleable condition. If I talk about it, I would say that since the NRV of the inventory is going down, what you need to do is that you should actually write down the inventory to the lower, because the value is already going down, the demand has fallen, so automatically the selling price is going to go down. So what do you need to do? You need to say that it's simple, the expense debit by 10,000 and correspondingly the inventory is credited by 10,000. That's what you need to do. Okay, now then again, if 50,000 was immaterial, the 10,000 will also be immaterial. So that means that it's immaterial, therefore no impact on the audit report. But now, the one thing that you need to understand is that Bradley is one single company. The scenario pertains to only one single company. So when the scenario pertains to only one single company, so what you should actually do is that it's not just about considering every matter in isolation. Consider them in aggregate. Consider them in aggregate. Like for example, there might actually be a possibility that we have got a statement of profit or loss which is 310,000 as the debit, and then we have got 50,000 as the credit. So at times what happens is a lot of items, when they are aggregated, so at times they become material in that sense also. But over here, if I talk about it, so it's actually just the share based payment that is a material item. You will not be able to find that the entire aggregation leads to a higher level of materiality. No, because the point is the inventory and the restructuring provision are such a small amount that they don't actually have much of an influence upon the overall amount at which it is recognized. So you need to consider about the aggregation also. I hope that this question is clear and there are no questions. Okay, so the misstatement would have been pervasive had there been multiple material misstatements. There are not multiple material misstatements. It's just that the share-based payment is material, the rest are immaterial. For the provision, I did discuss about it. Provision is only 50,000. So it's the 50,000 does not make it a material item. Valid expectation amongst those affected that a valid expectation amongst those affected by either announcing the main feature of it or by starting to implement the plan. Um, Okay, it can be pervasive in aggregate that, like, for example, if you would have got multiple items which are immaterial, but when you aggregate them, so it in total becomes 25% or 30% of the total net assets or something. So you might actually consider it to be pervasive impact. But over here, there are not multiple material misstatements. We will provide opinion on individual items also and in aggregate also. Why in aggregate also? The reason behind that is the whole question belongs to one company. Aggregate materiality, Ali Chaudhary, is something that basically when you have got multiple misstatements, you combine them together and see if they are material in combination. Yes, it's wholly judgmental, no set rules. But generally, pervasive is not something that you will you will actually give a qualified adverse opinion on every single case. Anyways, we're done with this specific question. Now, let's move further and let's just discuss further. So, if I move ahead, I will talk about the next question. We are done with this question number 5 of December 14. Okay, let's move on to this question number 5 of June 16. Okay, question number 5 of June 16. Let's talk about this question, which is question number 5, June 2016. Requirement A is explain the matters which should be discussed with management in relation to each of the uncorrected misstatement, including an assessment of their individual impact on financials. And assuming that then again the management does not adjust any of the misstatement, discuss the effect on audit opinion and the auditor's report. So let's have a quick go through of this question so we can move further. Okay, take 3-4 minutes and go through this area. Okay. Let's have a quick discussion on this. No, Rana Imran, we consider the material amounts also. Arvind, for the calculation of materiality for the group components, I am gonna give you an example. Don't worry, just wait for a while. Let's just talk about this question. You are responsible for the audit of Boston Company, a producer of chocolate and confectionery. The audit of financials for year ended is nearly complete, and you're reviewing audit working papers. Financial statement recognized revenue of 76 million, profit before tax of 6.4, and total assets of 104 million. The summary of uncorrected misstatements included in Boston's audit working papers, including notes, is shown below. The audit engagement partner is holding a meeting with management team of Boston Company next week, at which the uncorrected misstatements will be discussed. Now, what are these uncorrected misstatements? So let's just have a quick discussion about the uncorrected misstatements. If I talk about these uncorrected misstatements, number one of them is basically the impairment, which says the profit and loss has to be debited and the balance sheet has to be credited. So what does it say is during the year, Boston Company impaired one of its factories. The carrying value of the assets attributable to all the factories as a single CGU unit total 3.6 at year end. Fair value less cost to sell and the value in use were estimated to be 3 and 3.5 respectively. Accordingly, asset was written down by 100,000 to reflect impairment. Audit procedures revealed that management used growth rates of factories attributable to company as a whole to estimate value in use. Using growth rates attributable to factory specifically, the audit team estimated the value in use to be 3.1 million. Now, what is the requirement of the question? The requirement of the question explain matters which should be discussed with management in relation to each of uncorrected misstatements, including an assessment of their individual impact on the financial statement. Their individual impact on the financial, assuming that management does not adjust any of the misstatements, discuss the effect on the audit opinion and the audit report. Now, when it says the individual impact, now let's just talk about it. First of all, the relevant thing is IS 36, which is the impairment of assets. So when we talk about IS 36 impairment of assets, it says, what is impairment? Impairment is whenever the carrying amount of an asset exceeds its recoverable amount. Whenever the carrying amount of an asset exceeds its recoverable amount, resultingly we have an impairment. And what exactly is the recoverable amount? So recoverable amount is the higher of fair value less cost to sell and value in use. So the recoverable amount is the higher of fair value less cost to sell and the value in use. Now, if I talk about it, that how do we get this recoverable amount? What exactly is this fair value less cost to sell? And what exactly is value in use? So you consider this scenario. In this case, they said that the fair value less cost to sell was $3 million and this was $3.5 million. So they identified that the higher amount was 3.5 million. And when the higher amount was 3.5 million, so the recoverable amount was also 3.5. And resultingly, we have got a carrying amount of 3.6. So there is an impairment loss of 0.1, makes you 100,000 impairment loss. What have they done up till now? They have recognized an impairment loss of 100,000. Now, as an auditor, you figured out this thing, that this value in use of 3.5 million is an incorrect value in use. You as an auditor recognize this thing, that this value in use is an incorrect value in use. Now, what do we mean by incorrect value in use? Let's just talk about it. See, why is it an incorrect value in use? Because what happened is you are testing a CGU for impairment. And when you have to test the CGU, which is a factory for impairment, then the growth rates for the cash flows should be the same as this factory. The growth rate for the cash flow should be the same as this factory. Like you can't use the company's growth rate to value the future cash flow of this factory. You need to use the growth rate of this specific factory to value this factory. So what are you gonna do? You're gonna do this thing that you're gonna say that what exactly you're gonna say? You say that you need to use the factory's rate, and when you use the factory rate, the value in use is actually 3.1 million, and the fair value less cost to sell was 3 million. So the recoverable amount, which is the higher, is actually 3.1 million. So the recoverable amount which is the higher is 3.1 million. The carrying amount is we have written it down to 3.5 million. So that means there is additional impairment loss of 0.4 million. So this is what you need to explain to the management, that you need to recognize the additional impairment loss of 0.4 million as P&L debit by 0.4 million, and the asset is going to be credited by 0.4 million. That's what you need to do as a management. Now, the impact is the assets are, if this is not there, the impact is the assets are overstated by 0.4 million, and so are the profits, which are also overstated by 0.4 million. So that's what you need to talk about. The impact, individual impact of this on the overall financials is going to be the assets will be overstated, the profits would also be overstated. Now, next thing is that the questions requirement also says, assuming management does not adjust any of misstatement, discuss effect on audit opinion and auditor's report. So let's talk about the individual impact. So if I talk about the individual impact, so I'm going to say that this 400,000 divided by the profit before tax of 6.4 million gives you what percentage? Can anybody share that? What is the percentage? Okay, 6.25%. So it is 6.25%. So what is it going to be? It's going to be 6.25%. Now, so is it material? Yes, it's material. So if I talk about the individual impact, I would simply say that if it's a material misstatement, they don't make an adjustment, then you need to give a qualified opinion. You need to give a qualified opinion onto it. Now let's move forward. Let's just discuss further. So if I talk about the next one, it says interest charges of 75,000 relating to loan taken during the year to finance the construction of new manufacturing plant were included in finance charges. The manufacturing plant is due for completion in November 2006. This is an area of IAS 23, which is actually borrowing cost. So IAS 23 borrowing cost, what does it say? It says that borrowing cost on a qualifying asset the borrowing cost on a qualifying asset shall be recognized as cost of asset. Borrowing cost on a qualifying asset shall be recognized as cost of asset. Now, if I talk about it, so what is happening is it says that the asset has not been completed up till now. It's going to complete in November 2016, which is still 11 months from the year end. So that means it's a qualifying asset, because IAS 23 says that the qualifying asset is an asset that takes a substantial amount of time to get ready for use or sale. So what do we need to do? Here they have actually recognized the finance cost as debited and correspondingly cash credited by 75,000. That's what they have done up till now. Now what do we need to do? What do we need to do? We need to actually say that finance cost is going to be credited by 75,000, and we need to say that the asset is going to be debited by 75,000. So what are we going to do? We're going to say finance cost credited by 75,000, and we're going to say the asset debited by 75,000. So you need to explain to the management that you see the borrowing cost on a qualifying asset needs to be capitalized, and that's how you'll treat it. The next thing is the materiality. So 75,000 on, then again the profit before tax of 6.4 million. Even the 75,000 could be compared with the total assets of 104 million also. So how much is that going to be? Faranabi, the question's requirement is explain matters which should be discussed with management. So you need to explain the matters with management. Okay, it's 1.17. 1.17% is not material. Now, if it's 1.17%, if it's not material, then it says assuming management does not make any adjust any misstatements, discuss the effect on audit opinion. So now what you need to do is that you need to discuss with management that it's an immaterial, but the best practices should be that you perform accounting correctly. The best practices should be that you perform the accounting correctly. I mean, if you don't do the accounting correctly, it's going to be an issue. So the best practices are you need to perform the accounting correctly. Okay, let's move forward. Shirley, the videos, I think they are going to be shared with you over the email or something, but I think they've started to upload them on the Vimeo also. Now let's move forward. Number 3 is irrecoverable debt, which is the examiner says that 65,000 debited and the assets credited by 65,000. So say it says one of the Boston company's largest customer is experiencing financial difficulties. At year end, Boston owed 65,000 against which Boston made 5% specific allowance. Shortly after year end, Cleveland paid 30,000 of the outstanding, but has since experienced further problems, leading to their primary lender presenting a formal request that Cleveland be liquidated. If successful, only secured creditors are likely to receive any reimbursement. So you see, now what has happened with it? What has happened is you had this 100,000 as a receivable, and you had recognized an allowance at 5% gives you 5,000. So this is 95,000, and you have recovered 30,000 from them, so gives you a 65,000 as a receivable. So what do you need to do? It says if receivables are not recoverable, then they should be written off. So that's what you need to do as bad debt expense debited by 65,000 and receivable credited by 65,000. That's what you need to do. Okay, so that's what it is. And then again, it's apparently 65,000 on a total profit of 6.4 million will be immaterial. I think so. It's going to be immaterial. Rana Imran, this is not a P2 paper that you will get marks for writing down the name of the standard. 1.01% is then again an immaterial item, so it should be ignored. This is done, and then lastly you've got investment, which is 43,500. The investment which is 43,500. So it says that during the year purchased 150,000 share in Nebraska for $4. Boston classified the investment as financial asset at fair value through profit or loss. On 31st, the shares of Nebraska were trading at $4.29. At the year end, the carrying value of the investment was 600,000. So if we say that 150,000 shares, so 150,000, if you've got 150,000 as the shares, if you've got 150,000 shares and if you have purchased them at 4, so this is actually 600,000 as the original investment. Now, if they're trading at 4.29, so you will actually end up getting 643,500. You'll end up getting 643,500. So that is going to be 43,500. So if this is all going to be 43,500, now what next? This is then again you have to actually say that investment debit by 43,500 and the profit and loss account credit by 43,500. So that's what you need to understand. That's what you need to realize, that you need to explain to the management that these investments are being carried at financial asset at fair value through P&L. They need to be remeasured to fair value at each reporting date, and any gain or loss shall be taken to P&L. That's what you need to explain to the management. That's how you need to do it. Anyways, now I would appreciate if somebody could share the link to the answer of this question over here in the window, so the students can actually look at it. Try to open up here also from the ACCA's page. Somebody please share the link. Okay, welcome back. Sorry, there was some issues. That's why we got disconnected. But anyways, let's just move forward and let's just start discussing further. So, in the meantime, if you people had any questions, let me answer few questions. Uh, okay, this question. Let's just let's just discuss about the answer to this question. So, you see here, the impact on the auditor's report and the audit opinion. Let's just try to figure out the few things which the examiner has actually mentioned about them. So if I talk about these things one by one, I'm going to talk about them. Because I just want to highlight few things and want you people to understand that how the examiner gives marks also. Okay, so see here, what does it say in the answer? When considering their opinion, the auditors must conclude whether financials as a whole are free from material misstatements. In order to do this, they must consider whether any remaining uncorrected misstatements are material, either on individual or an aggregate basis. So you need to consider on individual and aggregate. Aggregate effects of misstatement would be to overstate Boston's profit by this and this. Now, how have they figured out this thing for 465,000 minus 118,500? This is, if you look at the exam question, you would say that the profit and loss is debited by this amount of 465,000. It's credited by 118,500. So the net amount earns 346,500. The total assets on the statement would also be overstated by this amount. This represents 5.4 of profit, 0.3 of total asset. Now, it does say the overstatement would be material. Now, what have they done? They've talked about aggregate thing, that the overall misstatement would be material. And furthermore, it says that as necessary adjustment regarding impairment is individually material, management should be informed that if valuation calculated is more appropriate, then failure to incorporate will result in auditor modifying. The type of modification depends on significance. In this case, the misstatement regarding impairment is material to financial, but is unlikely to be considered pervasive. This is supported by the fact that adjustment is not material to the statement, and it is therefore unlikely that auditor will conclude that financial as a whole are misleading. So you see, it has to be ideally material to both the things, so that it could lead to misstatement. Now, it says qualified opinion should be given. Furthermore, remaining uncorrected misstatements are individually immaterial to financial, and it will be at discretion of management to amend or will have no impact on audit report. That's what the auditor says. Now, very important thing is the marking scheme. Come over to the marking scheme of the question, because all that you need to do is that you need to understand the marking scheme of the question, that how the examiner is giving marks. It says in general up to 1 mark for each point of explanation and up to half a mark for each calculation. So whatever materiality calculations that you perform, they're going to give you half a mark for that, up to half a mark for that. Now, for the impairment, it has given mark for explanation of original calculation, inappropriate estimates, revised impairments, justification of proposed adjustment, further clarification, and matter is material individually. So these are the things that they have given marks for. Now audit report. It says aggregate impact will get marks, material to profit will get marks, impairment individually material will get marks, modification due to material misstatement, discussion of whether it is pervasive or not, qualified opinion and basis for qualified opinion para. So you see how they get the 6 marks. So a very important thing is you should be able to understand that where exactly is the examiner giving marks. So if you understand that where he is giving marks, that's what we are targeting. We are targeting marks. We need marks. So we need to actually be able to assess that where should we, what exactly should we do. That's how it has to be. I hope that this clarifies. Now, Sunny, I have 2 items of material, and if they are different items, you can say it is pervasive because then it's a multiple item. Anyways, so we have discussed up till now. Now let's move forward and let's just discuss further. So if I move forward, what exactly am I gonna do? Okay, now I need to recall something. I need to discuss something that I did not discuss with the audit report yesterday. You people have the audit reports in the handout. It's there in the handout. They haven't removed them. So let's have a pervasiveness is basically, Wali, you need to explain whether the matter is pervasive or not. That's all you have to do. We had various discussions, but we have not actually discussed the area of going concern up till now. So what I am going to do now is I'm going to start discussing about the area of going concern. That what exactly is this going concern all about. So if I talk about the going concern, and because I have discussed everything pertaining to the audit report except for the going concern. So first of all, I'm going to recall this ACCA 570, which is about the going concern. So first thing is ACCA 570, which is about going concern. Okay, now let's just see. If I talk about this ACCA 570 going concern, so first of all, let's just see that what exactly does ACCA 570 says, what exactly is going concern, what exactly is the auditor's opinion, etc., and the auditor's responsibility. First of all, you people do have an idea that the financial statements are mostly prepared on a going concern basis. Now, what exactly do you mean by that the financial statements are prepared on a going concern basis? This generally means that we expect that the entity will continue for foreseeable future. We expect that the entity will continue for foreseeable future. That's what we expect. Now, at times what happens is that if the entity is not a going concern, then we prepare the financial statements on an alternative basis. And the alternative basis is also called, we prepare the financial statements on an alternative basis, and the alternative basis is also termed as the breakup basis. So we prepare the financial statement on the breakup basis. And what exactly do you mean by preparing financial statements on a breakup basis? So preparing financial statements on a breakup basis actually means that you say whenever you prepare the financial statements on a breakup basis, so the breakup basis actually means that you say that if all the assets are being sold today if all the liabilities are being settled today, so the net amount that we are going to get is actually termed as the breakup value. So what exactly is a breakup value? So the breakup value is if all the assets are sold today, if all the liabilities are settled today, then what is the net amount that we are going to receive? That is considered to be the breakup value. Now, so it's actually the management's responsibility that the management have to determine if the entity is a going concern or not. It's not the auditor's responsibility to assess if the entity is a going concern. It's the management's responsibility to assess whether the entity is a going concern or not. The management, if they think that the entity is a going concern, they prepare the financial statements in a normal manner by applying the accounting standard as we know them. But if the management thinks that the entity is not a going concern, if the management thinks that the entity is not a going concern, then what they do is that they prepare the financial statements on a breakup basis. They prepare the financial statements on a breakup basis. Now, let's move forward. So that is one thing that we have talked about. Now I'm going to talk about further a few more things. So if I talk about few more things, is that what is the auditor's responsibility in accordance with the ISA 570? So the responsibility of the auditor is to basically test the management's going concern assumption. The responsibility of the auditor is to check if the management assumption of going concern is correct or not. So now what exactly is the auditor going to do in order to check if the management's assumption of going concern is correct or not? So in general, if I talk about it, so the entity's going concern is dependent upon a lot of factors, which could actually be the key ratios. And what would be the key ratios? That would be the key ratios of profitability. There would be the key ratios of liquidity. So there would be the key ratios of profitability, liquidity. They're important things. What else is going to be there? What else is going to be there? That is going to be like key personnels. If the key personnels are leaving, the going concern might be a question mark. At the same time, various contracts that they have. So that could also be another important point. So the point is that whenever we talk about it, we need to consider one thing. And what do we need to consider? We need to consider one thing, and that is that as an auditor, we need to see if the entity will continue for the foreseeable future or not. So if the entity will continue for the foreseeable future, then the entity is a going concern. If that is not going to continue for the foreseeable future, that means it's not a going concern. So now, what do we do as an auditor? What do we do as an auditor? So as an auditor, first of all, we need to see if the entity will continue for the foreseeable future. If it is going to continue, then all is okay. If it is not going to continue for the foreseeable future, then there is an issue. So what does ISA 570 tells us? ISA 570 tells us that first of all, if the entity is a going concern and the financial statements are prepared on going concern basis, then you have to do nothing as an auditor. Everything is okay, everything is fine. Now, number two is if entity is not a going concern, if the entity is not a going concern, then there could actually be two scenarios. Now, what could be the two scenarios? Number one of them is financial statements prepared on breakup basis. Number one of them is financial statements prepared on breakup basis. That's number one. Number two is that financial statements prepared on going concern basis. So how exactly are we going to react as an auditor? So if the financial statements, so number one, if the financial statements are prepared on breakup basis, that means the entity has done a correct accounting because it was not a going concern, and it has prepared the financial on breakup basis. So the audit opinion is going to be unmodified plus an emphasis of matter paragraph directing the user's attention towards the note reflecting that the entity is not a going concern. So that's number one. But if the financial statements are prepared on a going concern basis, but the entity is not a going concern, then this gives rise to adverse opinion. Now, why is it an adverse opinion? This is an adverse opinion because this is going to be an adverse opinion. And why is it going to be an adverse opinion? Because you do have an idea about it that if the going concern assumption is incorrect, that means it has a pervasive impact. It will have an impact on a lot of areas of the financial statements. So material items are misstated. That means it has a pervasive impact. Now what next? This is one area which is about the going concern. So if the entity is not a going concern, then financial statement should be prepared on breakup basis. If they are prepared on breakup basis, then an unmodified opinion with an EOM para should be given. If the financial statements are prepared on going concern, that means that's material misstatement having pervasive impact, so it has to be adverse opinion. I hope things are clear till now. Okay, I am gonna Sumaya, management responsibility. Okay, Asghar Khan, after the break, we are going to do a question on this going concern. And once we are done with going concern, I would try to pick up the other assurances. That's what I'm gonna do. Okay, wait, Arvind, I will discuss after the break that what do we need to do with respect to the this paragraph of material uncertainty relating to going concern. Let's have a break. We will have a break up till 7:40 p.m. So we would continue after the break from where we have left right now. Okay. Um, so before the break, we were actually discussing about the ISA 570 going concern, and what I had actually talked about ISA 570 was that it is the management's responsibility to perform an assessment whether the entity is a going concern or not. And the auditor's responsibility is to test the assumption undertaken by the management. So the auditor's responsibility is to test if the assumption undertaken by the management is correct or not. So we discussed about this thing that first of all, if the management has stated that the entity is a going concern, and the auditor figures out that the entity is a going concern, then there is nothing that is to be reported by the auditor. But if the management says that the entity is not a going concern, and they prepare the financial statements on a breakup basis, so then again the management has done what should have been done, which is that if the entity is not a going concern, the financial statement should have been prepared on a going concern basis, should have been prepared on a breakup basis, and that's what they've done. So the resultingly, what is going to happen? The auditor would then again give an unmodified opinion, but in addition to the unmodified opinion, he would give an emphasis of matter paragraph. Why is that emphasis of matter paragraph going to be there? The reason behind that is it's an important matter, and the auditor should draw the attention of the users to this matter, that look, go to XYZ note in the financial and you'll figure out that the entity is not a going concern. Another thing is that if the entity is not a going concern and the financial statements are prepared on a going concern basis, then what should the auditor do? The auditor should then actually go for the adverse opinion. Now let's move forward. There is something which is termed as material uncertainty to entity's ability to continue as a going concern. There's something which is termed as material uncertainty to the entity's ability to continue as a going concern. Now, what exactly is this material uncertainty? I'll give an example of material uncertainty. Example is that there is a court case against the entity, and the court case against the entity give rise to a contingent liability. Now, the court case which is against the entity is of such significance that in case if the entity ends up on the losing side, then the amount of settlement that it will have to make will be such a substantial, such a significant portion that the entity might not be a going concern anymore. So now, right now the current status is that the court case is undergoing. The current status is the court case is undergoing, and if the court case is undergoing, but we are unable to recognize the provision right now because it is uncertain if we would actually be required to pay or we will not be required to pay. So therefore, there is actually a contingent liability. There is actually a contingent liability. Now, ISA 570 states that this contingent liability casts a doubt on the entity, that it actually creates an uncertainty to the entity's ability to continue as a going concern, because if it materializes, the entity might not be a going concern. So what to do as an auditor then? As an auditor, our responsibility is to check if the entity has performed a correct accounting treatment in respect of this contingent liability. So now what is the correct accounting treatment? The correct accounting treatment is basically the management should give an appropriate disclosure. So ISA 570 states that whenever the entity is facing a material uncertainty to the going concern, then what the auditor should do is that the first thing the auditor has to do is the auditor has to say that if the disclosures that the management has provided are those, there could be three situations. There is one thing which is non-disclosure. There's one thing which is inadequate disclosure. And the third one of them is there is an adequate disclosure. So I'll repeat it again, that if there is an uncertainty, material uncertainty to the entity's ability to continue as going concern, the entity's accounting treatment has to be that it has to give an appropriate disclosure about that uncertainty. So auditor's responsibility is to check if the management has given appropriate disclosure pertaining to that uncertainty or not. So now what could happen? The first thing that could actually happen is, number one is, there could be a possibility that the management has not given any disclosure. If the management has not given any disclosure, then what is going to happen? If there is non-disclosure from the management side, then it is going to lead to an adverse opinion. It is going to lead to an adverse opinion, number one. If there is an inadequate disclosure, then the auditor will exercise his judgment. It could be a qualified, it could be an adverse opinion. But if there is an adequate disclosure, if the management has correctly disclosed, then there is an amendment in ISA 570, which is that the audit report should contain a section on material uncertainty to going concern. Then there is an amendment to ISA 570 which states that the audit report should contain a section which is about material uncertainty to the entity's ability to continue as a going concern. Now, let's just talk about it. You have the audit report handout from yesterday. Those who were not present yesterday can actually access it from the window. Okay, there's this page number 7 of this audit report 2 handout, and if you see, so basically immediately after basis for opinion para, there's this material uncertainty related to going concern paragraph, which is something that you can read and you can understand. Now, you would have seen that basis for opinion, it's a normal audit report. The entity was facing a material uncertainty to going concern. So if the entity is facing a material uncertainty to going concern, so what does it have to do? The only thing that the entity has to do with respect to it is that the entity has to disclose this material uncertainty thing in the audit report. So that's what they have done. So I hope this is clear up till now. It could be both depending upon significance. Yes, disclosure regarding contingent liability. Yasir, you can do past papers, but ideally better that you go for the revision kit. Yasir Sajjad, there is no minimum practice. It's always as much practice as you can do is good. But then again, I would always suggest smart study leads to pass. It's not hard study. It has to be the smart work. It's not necessarily the hard work which is needed. IFRA, what is inadequate disclosure is that you have not given the disclosure in accordance with the requirement of IFRS. Like IFRS might require you to disclose 3 things, but you disclose only 2 things, that inadequate disclosure. Now, come on to the past papers. There's December 2015. December 2015. Okay, I'll answer your questions in a while. First of all, let's come on to the question. It is December 2015, question number 2, part A, which is about Melvick and Co. So let's talk about this Melvick and Co., a firm of chartered accountant. The question is about Kendon Sky Company. Let's just try to attempt the question and then we'll move forward. Take 5-7 minutes so that we can discuss further. Okay. So we are on to this December 2015. Question number two, which is about question number two, part A, Camden Sky Company. Okay, so now the requirement of this question is, it says Malvick and Co. is a firm of chartered certified accountants offering audit and assurance services to a large portfolio of clients. So what are they offering? They are offering audit and assurance services to a large portfolio of clients. And it says that you are a manager in the audit department responsible for the audit of two clients, Camden Sky and Rothco, both of which have a financial year end of 31st July. The audit of both clients are being completed and you're reviewing issues which have been raised by these audit seniors. Now it says Camden Sky is a manufacturer of luxury food items including chocolate and other confectionery which are often sold as gift items individually or in hampers containing a selection of expensive items from the range of products. Due to an economic recession, because of an economic recession, sales of products have fallen sharply this year and the measures have been implemented to support the company's cash flows. You are aware that the company only has $150,000 in cash at the year end. Now, what exactly are the requirements of the question? So it says in respect of the audit of Canadian Sky Company. It says in respect of the audit of Canadian Sky Company, identify and explain the matters which may cast significant doubt on the company's ability to continue as a going concern. So you need to talk about the matters which may cast significant doubt on the company's ability to continue as a going concern. And number two is that you need to recommend the audit procedures to be performed in relation to going concern matters identified. So it's a 15-mark requirement. Ideally speaking, 1 mark per point, 1 mark per point. That's what you need to follow. So if I talk about it, number one is, requirement is identify and explain matters which may cast significant doubt on the entity's ability to continue as a going concern. So it says Canadian Sky, which is a manufacturer of luxury food items including chocolate and other confectionaries, which are often sold as gift items individually or in hampers containing a selection of expensive items from the range of products. Due to economic recession, the sales of the products have fallen sharply, and the measures have been implemented to support the company's cash flows. Now, if I talk about it, so the one thing is what could actually cast significant doubt on the entity's ability to continue as a going concern is that the economy is in recession. If the economy is in recession, that means the product sales have gone down. That means the product sales have actually gone down. That's one thing. Number two. Furthermore is that extracts from the draft financials and other relevant information are given below. So you've got the extracts from the draft financials and you've got other relevant information. There is this revenue which is 2440 and last year it was 3950. So if you could say the decline in sales. So how much has the sales declined? $38.2. If I will revert back to you with my email address. It's 38.2. Number one of them is 38.2. So how much is it? Is it 38.2? The sales have gone down by 38.2%. Now what else? The operating expenses have also gone down, but they've gone down by 25% only. The operating expenses have gone down by 25% only. As you will also get marks for the analyticals also. Whenever you perform analytical procedures, you get marks for them also. Now let's move forward. So it says revenue has declined by 38.2. The operating expenses have declined by 25%. The finance cost has actually increased. Finance cost has increased 20 upon 500. How much is there an increase of finance cost? 4%. What else is there? If we talk further, so what we can actually discuss is that the loss, the company has entered into a loss. It was a profitable entity, but now it's a loss-making entity. So the entity has become a loss-making entity. What else? I'm going to discuss the things, but let's just discuss the question first. The total assets, which were 13,500, have gone down to 10,400 now. So the value of the assets have gone down. So you could see that the assets have actually gone down. What is the reason behind that? We don't have an idea. Let's just talk. Long-term loan, note number one is there. Last year it was 3,000. Current year it's 3,500. It says the bank loan was extended in March 2015. What does it say? It says the bank loan was extended in March 2015 by drawing on the borrowing facilities offered by the bank. The loan carries a fixed interest rate and is secured on the company's property, including the head office and manufacturing site. The first repayment of the loan capital is due on 30th June 2016. And when 350,000 is due to be paid. Now you see there are three things. Number one of them is the bank loan was extended in March 15. So you extended the loan, you obtained more loan. The loan carries a fixed rate. The loan has a fixed rate and is secured on the company's property, including head office and manufacturing site. And first loan repayment is due on 30th June, when it is going to be 350,000. Now, so one of the matters that has actually arisen over here is that the loan is secured, and it's secured on the properties, but the value of the assets has gone down. It's secured on the properties, the value of the asset has gone down. Now try to understand one thing. If I am a lender, if I have provided money to somebody and they have given me security of some assets and the value of that assets goes down, so I will be concerned as a lender that what shall I do when under the current circumstances. The second thing is I would be concerned that what should I do under the current circumstances. That's number one. And the number two thing is going to be the company's financial position is also deteriorating. The company's sales are going down, the operating expenses, the profits are converting into losses. So this is also a cause of concern. Had the company been operating normally and the value of the assets had gone down, I would not have panicked. But now I need to panic. Why do I need to panic? The value of the assets are going down. The entity is itself running into losses. So I need to panic with that. Now what else? So that is also one thing. Next situation is the short-term liabilities, which is trade payables. It was 650, it's 900 now. It says Kandinsky renegotiated its terms of trade with its main supplier of cocoa beans and extended payment terms from 50 days to 80 days in order to improve working capital. So if you look at it, you would figure out this thing that you have extended the credit period. The credit period is also extended. You need to wait a bit. I'm going to come on to the overall issues, but I'm just reading the question, though. That's why I'm trying to summarize things. The next one of them is disclosed in the notes to financials. So these are actually the disclosures, the two disclosures. One of them is undrawn borrowing facilities. Last year it was 1,000. This year it's 500. Obviously, you have obtained 500 rupee further loan during the year. So the undrawn borrowing facility. Now it says the borrowing facilities are due to be reviewed by the bank in April 2016 and contain covenants including the interest cover is maintained at 2 and the ratio of bank loan to operating profit does not exceed 4:1. So now, first of all, let's just try to calculate these ratios, which is number one of them is interest cover. If you people have forgotten the formula for the interest cover, the formula is PBIT upon interest. And the next thing that you need to calculate is you need to calculate the other covenant, which is about bank loan to operating profit, which is about bank loan to operating profit. So if we can have a quick calculation of these, both for 2014, both for 2015. Okay. 1.4, 1.3 for 2014 and 0.65. Um, 0.65 and 1.3 and what else? Okay, if we look at it, I think there is something wrong with the way you people are calculating it, because the way it should be calculated has to be like this. You see, there is this, the revenue is there, the operating expenses are there, the finance cost is there. So what you need to do is that you need to calculate it this way. You need to calculate the PBIT first. How would you calculate the PBIT? The revenue less operating profit, or you can do is basically revenue less operating expenses. So it's 2440 minus 2100 minus 2100. So it's 2440 minus 2100 is going to be 340 at the PBIT in one case, and it is going to be 3950 minus 2800. It's going to be 3950 minus 2800 in the other case. So that's what you need to use. Please use the correct values. 2.3. And what about the bank loan to that ratio? Okay, now see, here we are breaching the bank's covenant also. Bank had requested us to have interest cover to be maintained at 2. It's not maintained at 2 anymore. And the bank loan to operating profit should not exceed 4:1. So how much is it? Okay, sorry. It's the other way around. It's 10.3 here and it is 2.61 here. So you see, last year everything was okay. Last year everything was okay. What has happened? In the current year the things have gone wrong. The things have gone wrong. Basically everything has gone wrong over here. Now what else? So I'll go back to the question again. The last thing is contingent liability of 120. It says contingent liability relates to a letter of support which Candid Sky has provided to its main supplier of cane sugar, which is facing difficult trading conditions. Now you have given 120,000 as a support letter to one of the main suppliers who's then again facing problem. Now let's just try to conclude the overall scenario, because we have read the question and we can now conclude the overall scenario, that what exactly are the matters which cast a doubt on the entity's ability to continue the going concern. So if I talk about them, Let's just talk about them one by one. So we could figure out that number one of them is the sales have declined and the market is actually in recession. The sales are not expected to go up in the near future also. The costs have not decreased at same rate as sales, and this actually indicates that if the costs have not decreased at the same rate, that means there is a high fixed cost, which is then again a risk, because in times of crisis it's actually the fixed cost that leads you towards the downfall. And what else is there? We have got the finance cost is there. In fact, the other issue that we have is with respect to the bank loan, where I talked about the value of securities going down. We can talk further that what other issues are there. There is this issue of that we have actually renegotiated the terms with the supplier. So the supplier has extended the credit period, but that is for how long? I mean, current support has been extended, but for how long? Now next, the borrowing facilities are due to be reviewed by the bank in April 2016 and contain covenants including that interest cover is maintained at so and so. At the same time, the bank covenants have been breached. The bank covenants have been breached. The bank covenants have been breached, and what else? The bank might withdraw borrowing facilities. The bank might withdraw the borrowing facilities. And furthermore, if you could see, is that the contingent liability that arises because of the support letter to the supplier is that the supplier is there and you have given him a support letter that in case of difficult time conditions we will support you. Now the problem is the supplier's difficulty has also started at the same time when you were also in a difficult condition. Now since you have got a long lasting relation, you might have to honor your commitment. So when you will have to honor your commitment, you will be running short of cash. So now if we talk further that will we be able to meet all our things or not? So now let's see. The current cash balance, which is the opening cash balance, is 150,000. I am expecting a loss for the next year, which is let's say 2016, of 180 again, assuming that nothing changes, assuming everything remains constant. So you have an opening cash of 150 and you are expected to have a loss of 180. Furthermore, you have a loan repayment of 350 which is due. In addition to this, if you have to support the supplier, that means you have to give 120 more. So apparently, if you look at it, if you look at these things, so you've got 150,000 of cash available. And with this 150,000 of cash available, you have got commitments of this is 300 plus 350 plus 650. You are going to stand at negative 500. And if you look at undrawn borrowing facilities, that is also 500. So the only thing that could lead to the entity surviving is the bank not withdrawing the borrowing facilities. The only thing that could lead to entity surviving is the bank not withdrawing the borrowing facilities. because you see the undrawn borrowing facilities. So this is what you need to actually consider. You need to understand that apparently this is also an issue. If the bank withdraws this borrowing facility, then there's going to be a problem. The entity will run into losses. So these are the matters which cast doubt on the entity's ability to continue the going concern. Now the next requirement is recommend the principal, recommend the audit procedures to be performed in relation to the going concern matters identified. So if I recommend the procedures that need to be performed, so what exactly are going to be the procedures that need to be performed? Let's talk about them. That what exactly are going to be the procedure that we need to perform. So if I talk about it, that what are the procedures that we need to perform in order to so I'm then again going to talk about that whenever we perform the procedures, remember whenever we perform the procedures, you always have to think from the risk perspective that what exactly are the risks. And whenever we think about risk, we always think what could go wrong. And then our procedures are to check if something has gone wrong. So now in this case, we need to perform the procedure on the going concern matters. Like we need to establish if the entity is not a going concern. So what are the things which would actually mean that the entity is no more a going concern? They are going to be, number one, the recession getting prolonged. That's one of the risks. Number two is basically the bank's reaction. Now what is going to be the bank's reaction? That is going to play a very key role. So if the bank's reaction is return the money, then that's going to land entity into a very difficult position. And what else is how long the supplier is extending the credit. Furthermore, the outcome of letter of support. So there are going to be a various factors which would indicate if the entity will be a going concern or not. So my thing is that I know that what are the risks, what are the things that could prevent the entity from becoming a going concern. I do know these things. But now if I do know these things, that what are the things which could prevent the entity from being a going concern. So what am I going to do then? What I actually need to do is I need to perform the procedures to check if these things are happening or not. Now try to understand. How would you know that recession period is going to be prolonged? So you are simply gonna obtain or inspect the economic outlook report prepared by central bank to establish likelihood of recession ending. Because you see, you need to think what could go wrong, what could prevent the entity to be going concern. What could prevent the entity from being going concern is, number one, will the recession period will it continue for long? If it is gonna continue for long, then the entity might not be a going concern, number one. The number two, the bank's reaction. What is gonna be the bank's reaction? So you might need to actually inspect the correspondence with the bank, that what has been the entity's correspondence with the bank. You might actually obtain a written, you might actually see that written representation, or you might obtain a written representation from management that they don't think that the bank would require repayment. Or you could actually, when it comes to the supplier's credit, you could seek an external confirmation from the supplier asking him that for how long the credit has been extended. Or you might actually go through this the commitment by the supplier that for how long has he given this extension. So these are the various things that need to be considered. I hope that things are clear now. So this is actually one of the scenarios on the going concern, but unfortunately there was no reporting implications on this. But anyways, that was one thing that we did discuss. Okay, the procedures are actually, you see, you need to think that what could go wrong. So what could prevent the entity's ability from being a going concern is that in this scenario, number one, if the bank's reaction, if the bank requires repayment, the entity will have to actually return the money. For that, they need to sell the asset, and if they sell the asset, then the manufacturing facility will not remain anymore. So where will they produce and how will they continue? So the biggest thing is the bank's reaction. You would inspect the correspondence with the bank to assess the likely reaction of the bank. You could actually discuss with management their plans of improving their interest cover ratio and then bank loan to profit ratio. So you could do those procedures to check, okay, what is going to be the reaction, because the bank definitely would not be happy with your performance. Anyways, let's have a short break, which is going to be a very short break, which is going to be a 5 minutes. So let's have a 5 minutes break, and then we will move forward and we will discuss further. So we are extending our class today, and it is going to be till 9:30 as we discussed yesterday also. So it is going to be break till 8:40 p.m. Okay, welcome back. So, up till now, over the last few days, what we have discussed up till now is we have gone through the various questions pertaining to the audit planning. We have gone through the questions pertaining to the review stage of the audit. We've also gone through a few of the questions on the um, we have also gone through a few questions on this audit reporting, and lastly we went through this question on the going concern. So now we are now going to move forward, and we are going to move on to the next area of the syllabus, and that area of the syllabus is about section E of the syllabus, which is about the other assurance engagement. So I'm going to start discussing about section E first, and then the last thing we'll do is the area of audit of the money laundering and the ethics, etc. Now, I'm gonna have a quick discussion. First of all, when we talk about IAASB, which is the International Auditing and Assurance Standards Board, so IASB has various publications, and what are those publications? They are ISA, which is the International Standards on Auditing. They are ISRE, which is the International Standards on Review Engagement. They are ISAE, which is the International Standards on Assurance Engagement. And they are ISRS, which is the International Standards on Related Services. So when we talk about this specific IAASB pronouncement, so at times the students don't exactly have an idea that where exactly do we need to use these various pronouncements. So what I'm going to do is that I'm going to explain few things. Number one of them is, first of all, let's just talk about the various types of engagements that an entity could enter into. So the number one category is the engagements which are assurance engagement. So the number one category is the engagements which are assurance engagements. So when we talk about the engagements which are assurance engagement, so the first thing that I'm going to talk about the assurance engagements is that the assurance engagements are of two types. One of them is based on historical financial statements, and the other one of them is based on other than historical financial statements. So when we talk about engagements which are based on historical financial statements, that could actually be an audit engagement, and that could actually be a review engagement. What is an audit engagement is done using ISA. The review engagement is done using ISRE. And if we talk about other than historical financial statements, so on such engagements, ISAE, which is the International Standards on Assurance Engagement, that applies. I will discuss that what exactly are these various types of engagement. So that's one of them, which is the assurance. Number two is basically non-assurance engagement. Such engagements where the auditor does not give any assurance. So whenever there are engagements where the auditor does not give any assurance, such engagements are covered up by ISRS, which is the International Standards on Related Services. So the first thing that I'm going to do is I'm going to talk about, I'm going to discuss about the differences between an audit and a review. So if we talk about the audit and a review, that what exactly is the difference between an audit and a review. So the major difference between the audit and the review is number one of them is majorly the audit is in audit we give a reasonable assurance. In a review we give limited assurance. Now why exactly is that so? Because all procedures here only inquiry and analytical procedures. So one of them is a reasonable assurance, which is all procedures, and the limited assurance, which is inquiry and analytical procedures. And then there is this positive form of conclusion, and there is this negative form of opinion. So the major differences between the audit and a review are: the audit gives rise to reasonable assurance, the review gives rise to the limited assurance. And when we talk about the audit, so we perform all the procedures when it comes to audit, but when it comes to review, we only perform the limited procedures of inquiry and analytical procedures. I'll talk further, and if I talk further, what exactly are the further differences between this audit and review, and how do these differences arise? So you see, whenever we are performing the audit, we perform all the possible audit procedures, which could be inquiry, which could be analytical, which could be external confirmation, physical inspection, recalculations, etc., etc. Why? Because the extent of audit is very detailed. The audit is quite a detailed engagement. That's why the result is we give a reasonable assurance. But when it comes to a review, we don't perform detailed procedures. We only perform inquiry and analytical procedures, because we are not there to give a high level of assurance. We are there to give a reasonable or a moderate level of assurance. So basically what happens is, whenever we are giving an audit opinion, we give a positive form of opinion, but when it comes to a review, we give a negative form of opinion. Now, what exactly is a positive form of opinion and what exactly is a negative form of opinion? So let's just talk about the positive and the negative form of opinion. If I talk about this positive form of opinion, so the positive form of opinion is the opinion that we generally have, which is the financial statements give a true and fair view. The financial statement give a true and fair view. Then there is this negative form of opinion. And what is that negative form of opinion? The negative form of opinion is financial state. Nothing has come to Nothing has come to our attention that causes us to believe that the financial statements do not give a true and fair view. Nothing has come to our attention that causes us to believe that the financial statements do not give a true and fair view. So now see, when we are talking about an audit opinion, we are saying financial statements give a true and fair view. But when we are talking about a review engagement, we say nothing has come to our attention that causes us to believe that the financial statements do not give a true and fair view. So that's where the difference lies. In one case, you're talking in a very, you're talking with a lot of authority. But when it comes to the negative form of opinion, you're not talking with a lot of authority. You say nothing has come to our attention that causes us to believe that financials do not give a true and fair view. Is the problem resolved now? Okay. Now, so we have gone through it. So that one of them is a positive form of opinion and the other one of them is negative form of conclusion. So we were talking about the audit and we were talking about the review. So we have discussed one thing. Now, where does the review comes in? So at times what happens is, like whenever the entity has prepared interim financial statements, the interim financial statements which are prepared by a listed company on a quarterly basis in accordance with IAS 34. So it's actually those financials are not audited, but instead they're reviewed. So the review engagement comes into play. Then another case where the review engagement comes into play is at times what happens is there are various jurisdictions where the audit is not mandatory, but still the external stakeholders want to have a look at the picture. So if the audit is not mandatory and the external stakeholders are willing to look at the picture, then what they actually do is that they get it reviewed. Because the audit is an expensive item, the review is not that expensive, so they get it reviewed. So that's where the first difference lies between the audit and the review. So ISRE, which is the international standards on the review engagements, they are actually applicable to the review engagements. Now the next thing is we talked about, so up till now what we have discussed is one of them is the audit of historical financial statements, and then again the review engagements also cover up the historical financial statement. Now the next area that I'm going to talk about is the other than historical financial statement. Now what are these other than historical financial statements? Now if I say other than historical financial statements, other than historical financial statements are, number one, when we say other than historical financial statement, what exactly are these other than historical financial statements? First of all, you see, an entity prepares a lot of information which is not pertaining to historical financial. Like for example, entity might prepare forecasted financial. Like when you go to a bank for a loan or something, the bank would require you to give a forecasted financials. The entity might prepare a forecasted financials. So the forecasted financials, when you present them to the bank would say that we can't trust upon you. How could we believe on these financials? We need an independent opinion. So what do we do in that case? What we do in that case is we go to an auditor and we request them that how about if you perform a review of these, or if you give some assurance on these forecasted financials so that the lenders could actually believe upon them. That's number one. Number two is basically when we move further. So what else can we talk about? If we move further, so basically it is at times the entities, they prepare the KPI report. Like a lot of companies have to prepare KPI reports and they need to submit to the various authorities. So if you've got certain KPI report and if you're submitting it to any authority, the authority would also request you that you get it independently verified and you get an assurance report onto this, that this has been correctly prepared. So at times you prepare KPI report, you need to have the assurance. So then again the ISAE comes in. At times the entities would have prepared the CSR report. The CSR report would also be verified or would also be authenticated by the auditor. So you would also give a report onto them also. So basically ISAE comes into them. And lastly, it's a non-assurance report. Non-assurance engagement are those engagements where there is no assurance. The two common things are agreed upon procedure. The two common things are agreed upon procedures, AUP. What exactly is an agreed upon procedure? For example, when we go for an audit, then we plan the audit, we perform the procedures on our own. The entity does not guide us. But when it comes to this agreed upon procedure engagement, it's an engagement where the entity guides you what to do. And all that you do as a firm is you follow what the entity has told you to do. Like for example, when it comes to preparation of fixed asset register, the fixed asset registers are being prepared. The fixed asset registered are being prepared at the instructions of the entity. So the entity, if the entity requires you to prepare a fixed asset register, they would actually highlight that you need to give the tagging to XYZ area, you need to give property this tagging, you need to give equipment this tagging, you need to give fixtures this tagging. They would specifically identify that what sort of tagging do you need to give. So one of them is agreed upon procedure, and at times there are these compilation engagements. Now, what exactly are these compilation engagements? So if I talk about the compilation engagements are generally engagements to compile financial engagements to apply the data. So one of them is basically the pronouncement of IAASB, which is the ISRE, ISA, ISAE. The first thing is you need to understand where exactly are they applicable. Um, okay, Vajia has asked a question that what if we are performing a review and we need to qualify our opinion. So you can qualify your opinion by saying that except for the effects of the matters discussed in basis for qualified opinion section, nothing has come to our attention that causes us to believe that the financial statements do not give a true and fair view. So you can do it this way. Yes, the CAM is only for listed company. The due diligence could be a review engagement. The due diligence could be an assurance engagement. Depends upon because when it comes to due diligence engagement, if you are focusing on financials only historical, then it's an review engagement. If you are focusing on all aspects, then it could be an assurance engagement. Okay, so now this is a basic introduction to these things. We are going to move forward and we are going to discuss further. If you could come on to a question which is question number 2 again of December 2015. It's December 2015. Question number 2, part B. If you could please come on to that question, which is called Rothko University. If you could please come on to this question and have a quick look at this. Take 2-3 minutes, then we'll discuss. Okay, now let's just talk about this area which is called Rothko University. I'll come on to the requirement of the question first. It says discuss the relevance and measurability of the reported performance information. It says discuss the relevance and measurability of the reported performance information. Now, and recommend the examination procedures to be used in auditing the performance information. Now, first of all, we'll read the question and we will discuss it. So the question says, Rothko, a public sector university, is a small university with approximately 2,000 students, which was established 10 years ago, and it specializes in vocational study programs leading to award of degree based on so and so. Highest performing students achieve a distinction in completing their degree program, indicating excellence in the knowledge and understanding of their subject. Now, students pay tuition fee of 10,000 per year, and degree program is typically 3 years long. So it says the audit work in respect of year ended 31st July is almost complete, but the audit senior has not yet completed the audit work in respect of performance information, which is being completed, etc., etc. So it says that performance area is graduation rate, academic performance, employability, course satisfaction. First of all, the question is discuss the relevance and measurability of the reported performance information. Now, first thing is, the part A of the requirement is not something that you would expect an auditor to answer, but then again, it's there in the syllabus, and you need to know it. So first of all, if we say discuss the relevance and measurability of reported performance information, so what do we mean by relevance? Now, we are auditing the information of a university, and these are the 4 performance area: graduation rate, academic performance, employability, course satisfaction. Now, why are they important? Now, first of all, graduation rate. Any specific university, people do go there for graduating, not there to get old without any degree. Like you have entered into ACCA, every one of you wants to do ACCA. Every one of you wants to complete the degree. So when you would have opted ACCA, you might have considered this, that what is the graduation rate of ACCA. So yes, that is something that you do consider. What if the ACCA had a graduation rate of 1%? Nobody would have ever opted ACCA. People would have said, we are not amongst the 1%, so why even think about doing ACCA? So the graduation rate is one thing that people do consider. Number 2, academic performance automatically. Let's take an example of any ALP. You would see that what is basically the result of that ALP. The employability, the ACCA qualification gets its value the more the employers are looking for ACCA. If the employers stop recruiting ACCA, the people would have stopped doing ACCA. So it's actually about the employability is also important for any specific university, that how well the university's degree is reputed amongst the employers. And then the course satisfaction is that are the students happy when they are studying this university. So this is all important. And now the question is, we discuss the relevance. So this is all relevant for any specific university, number 1. Number 2 is about measurability. Now when we talk about the measurability, so the measurability is like, are these things measurable? Are these things quantifiable? So when we talk about the measurability, so measurability actually refers to that, are these quantifiable? How easily can we measure them? How easily can we quantify them? So we'll talk about it like graduation rate is easy, academic performance is easy, employability is something of a subjective item because it's actually the employers, you need to do an employer survey, which is an external information. And then there is this course satisfaction is then again the student's judgment and etc. So you need to take a student's opinion, etc. So relevance and measurability, this is measurable information to a large extent and it's relevant also. Now recommend examination procedure. Now this is where the students actually mess up. They don't really understand that how to perform the examination procedure, because a lot of time it has happened that such questions have come into examination. The students have performed so badly in these. Why? Because when such things come in, they actually they lose it. I mean, they don't know how to handle them. So a very easy way to handle them is, number 1, you need to think what could go wrong. You need to think what could go wrong. Whenever there is a procedure, You name it, examination procedure, you name it, audit procedure. You just need to think what could go wrong. Now, see. Number one is percentage of students who complete their degree program is 85%. So now, I am somebody who's performing an assurance engagement and I need to check if this 85% is a correct value. How will I do it? It's very simple. I need to think what could go wrong. My risk is that this information is not correct. Okay. So how could I check it? How could I test it? It's very simple. All that you know is that it's a 3-year program. It takes 3 years for this degree program to be completed. So all that you could do is that you could take the data of the students who were recruited 3 years earlier, and you could see the data, you could match them with the people graduated in the current year. So you'll get the proportion. So one of the procedures is simply going to be randomly comparing, or you could actually specifically do a performance of procedure on one of the batch which actually was enrolled 3 years back with the graduation that has recently taken place, that how many of them graduated. Number two, percentage of students achieving a distinction. Now, your procedure is going to be that you inspect the distinction criteria and then you compare the results of those students whom the university claims to have achieved distinction with that criteria to confirm if the distinction has been achieved or not. It says percentage of students who obtain graduate level employment upon graduation. All that you need to do is that you need to randomly pick up few graduates, you need to give them a call, you need to ask them that how long did it take for them to graduate. Now, ideally speaking, you should send across a letter to them and seek confirmation because written evidence is better. But then again, it's very simple. You just need to think what could go wrong. You just need to think about verifying this information. That's what the procedure does. Then the course satisfaction is simple. You can have the students fill up the form. You can have the students fill up the data so you get the idea. So I hope that you people understand this. Anyone has any questions in this? Ifra, if you have an idea about how the audit firms are operating these days, so the income from the advisory departments is usually greater than the income from the audit department. So the advisory services are being provided by every single audit firm, and when they provide the advisory services, so they can do anything other than historical financials also. Yes, you can inspect criteria and recalculate also. Darwin, I don't think we will be able to do it. Yes, ISA 3000 is the general ISA. Bilal Qasim, we will discuss about the ethics tomorrow. Well, relevance is why is it important? Measurability is it quantifiable? Yes, Wali, you are right. No, sufficiency is not relevant over here. Rohit, you are trying to refer to a matter which could appear in both CAM and EOM. Yes, in fact, no. Why? Because EOM only is there for a matter which is correctly presented in financial. But if there is a matter on which you had a lot of work, which was risky in your opinion, then it's not going to be EOM. It's going to be reflected in CAM only. Rabia Khalid, my focus for tomorrow is going to be that I would be going through an short due diligence area, because I think that amongst the assurance services, due diligence is an area which can be important for this session. And the second one of them is that I will be going through the ethics, quality control, these things. IASB, the International Auditing and Assurance Standards Board, actually gives 4 pronouncements, which is ISA, the International Standards on Auditing; ISRE, which is the review engagement; ISRS, which is the related service; and ISA, which is assurance engagement. Ahmad, no, we are not going to do. We're going to just keep it till here. Wajiha, we won't cover PFI. The reason being PFI was tested in the previous session, so I don't think it's important. Wali, my suggestion to you would be to do the revision kit and ideally do at least 5-6 attempt past papers. Yes, forensic we will cover up. We would be covering due diligence tomorrow. No, Wajia, we won't cover current issues. Doing it once is sufficient if you do it properly. That's what I always do. And if you would have seen that my focus has not been to do as many questions as possible. My focus has been to do limited questions, but do them very well. So that's what my focus has been. I would suggest you people to cover up. Vadia, I think you can even pass without doing current issues. My suggestion to you people should be that tomorrow you should have done December 14, question number 3 on your own. December 2014, question number 3 on your own. Try to do it. Yes, accounting standards are important. Hen operating lease can be examined. I will cover up this in the WhatsApp group. I mean, once we are done with this session, I would cover up the accounting standards. Rabia, I have got limited amount of space available for the handouts, because I cannot give many handouts onto this screen. We'll share accounting standards. Wali, I would suggest that do last 6 attempts. Which part, eh? Ishaq, I will share. Yes, written practice is important. Poonam, we have already gone through IFRS, this part A of Malvic company, which was in the going concern. Rarvin, that's not important. I'm going to share the review report format. That's not important. Poonam, you can actually see the recording. They are being uploaded on the Vimeo page of ACCA. Yes, recent article has arisen. I am going to give you a list of entire things that you need to go through. Don't worry about it. Sania Kadi, the advocate opinion was basically, can you hear me? Okay, the advocate opinion was basically that I gave an example that material uncertainty to going concern might arise because of a contingent liability. So if there is a contingent liability, you need to give an advocate or an appropriate disclosure. If you don't give an appropriate disclosure, so that is something that gives rise to the auditor giving a qualified opinion. Yes, Wali, you can send me a past paper. You can give me a question and I'll do it. Don't worry. IS 37. Rohit, they would be sufficient. Either 570. Anyways, thank you very much. Let's join in tomorrow. So we'll have a session tomorrow, inshallah. We'll try to cover up maximum things. Anas, I will try my best to actually mark them out, but I would suggest that do one question and I can have another webinar session being conducted. We will have a mock debrief also.